Good afternoon, everyone. I, Ankit, on behalf of NEN and Vadvani Foundation, would like to invite you all for this webinar and also introduce our expert, Mr. Puneet Vatsayan. Puneet is a serial entrepreneur, international business executive, and mentor. Puneet has been an entrepreneur in both India and US, an investor in India, US, and Europe. Puneet is the co-founder and chairman of Hatch Incubators, co-founder of the Angel Investors Consortium, and board member of Cosmos Hospitals. In addition, Puneet is actively involved as a member of the CII Confederation of Indian Industry, National Committee on IT, ITES and Ecommerce, the CII National Committee on MSME in Defense and Aerospace as President of TIE, Punjab and Chandigarh, until recently as a member of Global Board of Trustees of TIE Global. As a serial entrepreneur, he founded 3 ventures, all in the technology and IT domain in India and Silicon Valley. Prior to starting his entrepreneurial career in 2000, he worked with Centigram Communications, acquired by ADC Communications in worldwide product management, international marketing and services marketing groups. In addition, he has worked with Megerix Corporation, now Honeywell, and US Borex RTZ in international marketing and business development. Before I hand over the floor to Puneet, a quick note to all our attendees. You will all be on mute. You may ask questions by typing in the panel provided. Our expert will answer the questions after his presentation. Over to you, Puneet.
Thanks, Ankit, for a very kind introduction. Good afternoon, everyone. The topic today that I've been asked to talk on is about investment trends and what we, as a part of the entrepreneurial ecosystem, see as hot investment trends in India. Before I start my presentation, I just will start it with 2 thoughts. Number 1, most entrepreneurs link investment trends and hence design a business plan around investment trends. Typically, it is not a great idea to link your business plan around investment trends, because any business plan, and more importantly, any execution of a business plan, should be in an into, and which is typically most investors, especially the good ones, typically would invest ahead of the curve. Any economic scenario typically is a sine curve where you have an early trend, you have early adopters, you have the technology in its growth phase, you have technology in its maturity, and you have technology looking to reinvent itself. Most investors will fall in any of these categories, and there are investors who make phenomenal amounts of money in all these categories that I just spelled out. The early investors, typically the investors who invest in early stages of a technology cycle, typically would invest before the technology and the early adopters come in. For any entrepreneur, that doesn't mean that if they have missed out on investors who invest early on in the cycle, translates into that they will not get invested, or that have raised money either through angel investors or through venture capitalists. Where India is in its economic cycle today, we are seeing a very broad area of growth. And if you look at the investments over the last 3-4 years, they are all across. Birdseye is a company that got invested. They are in the whole area of live traffic information for road commuters. Peelworks is a company that focuses on Salesforce automation. Duffer is a group buying for housing. Mobile NXT is for physical stores for cell phones. Tune Patrol is an online platform for the independent artist. Zop now is an online grocery store. All School Stuff is an online platform for buying school-related stuff. Desi Crew is a rural BPO. Conshore Medical a company that's focused on medical devices, thoughts around educational programs, gray orange, robotic solutions for retail, Game on India for gaming, prompt renewables in the whole tech, whole area of clean tech. The idea I'm showing these 2-3 slides is to give you a perspective that where India is in its broad economic curve, all sectors right now are investable sectors. And any investor who is looking to make an investment in a company is typically looking at a couple of things, whether it's early stage, growth stage, or a mature stage, or a mezzanine round investor. Typically is looking at the team's ability to execute on the business plan, the robustness of the business plan, the market opportunity, the team's ability to capture the market opportunity, and the team's ability to capture both mind share and market share in that market space, if you will. Investors are opportunists. They invest in areas where they feel that they can make an oversized return. And typically investors that would invest in private enterprises or startups or companies that have not gone public, look at some interesting benchmarks. If I put money in a fixed deposit, I get a 10% return. I put money in a debt fund, I get between 12 and 15% return. If I put money long term in public markets, which is investing in the stock market either directly or through a mutual fund, historically in India that return is between 15 and 20%. If I invest in the informal money lending market, the return is between 1.5%, 2% a month. So which is on an annualized basis between 18% and 24%. So any investor that's looking to invest in a startup is looking to get a return on investment that is higher than the numbers that I have quoted. So when you are evaluating your own business plan and are deciding and evaluating which investors to go to, that kind of number you have to keep in the back of your mind. And if your business can generate a return on investment that is comparable to these benchmark numbers or higher. Another key question which is of relevance to you is which investors do you want to raise money from and where you are in your business plan. If you look at who are the typical investors that are out there, you have angel investors. These includes family and friends and informal money. Angel investors will typically come in the very, very early stages of your business when you are looking to prototype or you're looking to mainstream your product, or you are essentially looking for investors while your business is very young. VCs are organized venture capitalists, as you may have heard, are venture capital funds. They will typically come in when your product or solution is somewhere between the early adopter stage and growth stage. So the angel investors come in at the time when you're at a prototype stage and looking at some early adopters. Venture capitalists will come in around the time that you're beyond prototyping and you are looking to reach out to a whole bunch of early adopters. Now that doesn't mean that VCs do not give early money, but it's typically rare for them to cut a $100,000 check. Private equity guys are essentially VCs, but they will come in when you're looking to expand the market opportunity of your product. So if you look at what typically angel investors would put in a company is anywhere between 5 lakhs to about 2 crores, give or take some. Sometimes angel investors go as high as 4 or 5 crores, depending on market conditions, market opportunity, other investors, and appetite of angel investors. VCs would typically come in anywhere between 2 crores to 50 crores, of about 500,000 to about 10 million. Sweet spot typically being $2 to $4 million around. And private equity guys would typically come in when you're looking at a 10 plus million or a 50 crore plus ticket size. So the question that most entrepreneurs typically ask is, so what do investors actually invest in? The investors invest in a business case, the team's ability and commitment to execute on that business case, the quality of the opportunity and the opportunity being large enough, and the quality of the plan. So another question that becomes is, what do investors not invest in? Typically, investors would not invest in ideas that are without a plan, are not well thought out, do not have what if scenarios addressed, teams that are not robust, teams that can't work together, teams that typically have a very low aspiration in terms of growth rates and the ability to capture. Concepts addressing very small or niche markets. Point number 3 is also important, that if your idea is addressing a small or a niche market, then it doesn't mean you do not get investors that don't invest there. It's just that this class of investors, which is the VCs, private equity guys, angel investors that are doing a valuation play, you will not go to them. You will go to another class of investors that are looking for dividends or other forms of return on capital. So at this note, I thought we'll just ask it out to the audience for any questions that they have. Okay.
The first question is from Mr. Sunny Rai. What is the scope of agriculture entrepreneurship and whom to look for funds?
So I think it's important. The scope of agricultural entrepreneurship in this country is huge. If you look at any sets of data, we are adding population, our land size is limited, our productivity in agriculture and yield in agriculture is low. So the opportunities in the agriculture sector all across, right from biotech to seed to fertilizers to cold chaining to logistics to farming is huge. I think the question that you ask is, whom do you go for funding, is a mixed bag, because I don't know what exactly within the agricultural sector you want to go after. The funding sources are all the way from NABARD, which is the National Agriculture bank, to state funding on agriculture. There's a lot of money that's available through individual states and the departments of agriculture and the marketing, agricultural marketing boards in each of the states. To angel investors, to VCs, to private equity guys. Right now, this is one of the markets where there's a lot of interest.
Yeah, the next question is from Mr. Sumit Sahu. What are PEs?
PE is private equity. The PE stands for private equity. These are the full form would be private equity funds. The way, and I thought I'll just explain to you, there's fundamentally no difference between a venture capital fund and a private equity fund in the way the funds are put together. The difference is in how much money a VC would typically invest in a company and how much a private equity guy will put in a company. VCs will typically put around 2 million as a sweet spot, US, which is about 10 crores in a typical deal. Private equity guys will put in 10-20 million, so anywhere between 50 to 100 crores. So if you are looking to raise 50 to 100 crores, you would go to a fund that makes that ticket-sized investments, and that would be a private equity fund. If you look at how both VCs and private equity guys are organized, you typically would, the organization is something called LP and GP. LP is a limited partner, GP is a partner who executes and implements the fund, is a general partner. The nearest analogy I can explain to you is a mutual fund. You as a typical retail investor, if you want to participate in a stock market, would put money in a mutual fund. So that would be an LP for a VC fund or a private equity fund. And in case of a mutual fund, you'll have an asset management company that then collects funds from all these retail investors, puts it in a corpus, and makes buying decisions, which means how to deploy that capital in which company, at what stock price to buy and what stock price to sell. That role is performed by an asset management company. So in the case of a VC or a private equity fund, that would be a GP that would make that decision. And the decision the GP would make is, would go scouting for deals, will evaluate deals, will evaluate business plans from entrepreneurs, and make investment decisions, which means at what price to invest in a company and what price to exit on a company.
Next question is from Mr. Marchand. Is 15 to 18% a good return to offer an investor?
Again, the industry thumb rule, I don't understand your personal situation in terms of how much money you've raised, but typically the thumb rule is every funding round you're looking to get diluted about 20%. Then it's a question of commerce between the investor and the entrepreneur, but if you are looking at 15 to 18%, that's a good number if you can manage it.
Next question is, how important is it to have a team or a partner before reaching out for funding?
I think, again, it depends on which investor you go to. So if you are just two people and a PowerPoint and you go to a private equity guy who's looking to invest 50 crores or more, chances are you'll be thrown out of the door. If you go to a VC and you are, one founder, a business plan, some UI, a prototype that is under development, chances are you may or may not be entertained, depending on what your background is and whether you've done it before and whether you're a serial entrepreneur. If you go to an angel investor or you go to family and friends and you're looking for money, they're also investors, and you are one individual, you're passionate about an idea, you've built a prototype, the chances are they'll cut you a check. So you got to choose which investors you go after at which stage in your company.
If you already have a working software product available online, but no client database, will it be eligible for VC funding or only angel funding?
The question you've asked has a lot of merit. Typically, if you're just giving me the information that you have a product that is available online, you do not have customers yet, and my off-the-cuff response would be that you'd be eligible for angel investing would be a right way to go about it. And depends which space you are in the online space, because some angels or most angel groups, if you are in popular spaces, may want you to have evolved and gone further along in your journey before they will make an investment decision. That said, if you are a in the online space and you don't have customers, however you have an incredible team and the team has done some startups before, either as founders or as early employees, you may also want to consider VC funding.
If I want to go to VC for funding, will they take some share in the company or profit, or what is it?
So VC will take a share in the company. These are equity investors, and they are there to increase the valuation of the company. So most VCs would not be looking at dividends. They're looking to increase the valuation of the company.
Now, next question is from Mr. Apurv Agarwal. How many good funds are there in India which invest money in $100,000 to $150,000 checks? Is there any accelerator that invests that kind of amount for early stage startups?
So in the range of 100,000, now the numbers of funds are increasing. There's the seed fund, there's Bloom Capital, there are a number of funds, there are a number of formal angel networks, the Indian Angel Network, the Angel Investors Consortium, Mumbai Angels, Hyderabad Angels, Bangalore Angels, Pune Angels, and you also have individual angels who may or may not belong to these networks that put in money. There are accelerators, there's Morpheus, there's Hatch, there are other accelerators. Typically accelerators would put in about $20,000 to $40,000 and will bring in other investors to make that kind of investment decision.
Next question is from Mr. Ajay Bansal. There is a notion that as soon as an investor comes in, the independence of an entrepreneur goes out of the window. While this independence and risk-taking is the fundamental to entrepreneurship, how do you as an entrepreneur deal with this situation?
So if I was to answer this question, I think most investors typically want the entrepreneur to run with the business. Investors don't want to be in the business of running a business. All investors will bring in a certain degree of discipline, process, procedure, and focus on an entrepreneur. Investors will make money when entrepreneurs are able to scale their business. So yes, there will always be, if you want money and you don't want oversight, I don't think anyone's going to give you money. Even on the public markets, even if you're publicly listed, you have SEBI as a regulator that regulates and imposes certain conditions. Let me give you a very anecdotal evidence, and it's about a popular company called Google. When the investors put money in on the two founders of Google, they felt that the founders were great technically. They had a great product. Yes, it was a struggle for both the founders, Larry Page and Sergey Brin, to get the initial investment in. But that investment came with a catch. The catch was They felt that the entrepreneur did not have the management skills to be the CEO of Google. So if you are a student of history of Google, or even if you Google, you would realize that Google actually got an outside CEO to run Google. And both Sergey and Larry became individual contributors in a company that they had founded. It took 10 years when Larry had matured, and the CEO was elevated to become the chairman of the board, and Larry became the CEO of the company. So most investors, so as entrepreneurs, I think your bigger worry shouldn't be loss of independence. Your bigger worry is, are you creating value for yourself and for your investors? And the value here is a direct proportion to valuation. And if you are creating value to your stakeholders, I don't think any investor is going to interfere too much. Issues are going to start when you as an entrepreneur are not doing your job of increasing the valuation of your company.
Next question is from Ms. Richa. Social entrepreneurship shall approach the government bodies or the angels, which is a safe or better place to go?
I think you got to be, you will go approach whoever is willing to give you money. I think you got to understand that social entrepreneurship also is about making the enterprise sustainable. It may not necessarily mean that you're going to profit from the social enterprise, but it does mean that you will charge for products and services so as to make your organization sustainable on a long-term basis. Governments are good places to go because initially they give you grants, they give you subsidy, and grants and subsidies help out in building out your business. Angel investors will cut checks in social enterprise out of passion around the opportunity, around making a difference, around a shared vision. And angel investors will bring in a certain degree of discipline into your thought process. They will ask you questions that bring in focus.
Next question is from Mr. Balaji Mani. How is the investment trend in IT product companies today in India?
The IT products company is a hot area, and if you are reading any of the popular investment sources, be it the Economic Times, VC Circle, or any other news consumption sources that focus on investments in India, you will see that the trend is towards product companies in India, and that is also because of multiple reasons. India as a market and a consumer for IT products is becoming large, and hence you are seeing investment opportunities there. So if you look at any of the angel sites, the Indian Angel Network, Mumbai Angels, Angel Investors Consortium, you will see product companies increasingly be the ones that are getting funded.
Okay, now Vaibhav Vijay has a question. How much equity do VCs and PE take for their investments? In what range exactly?
So typically VCs and private equity guys in any funding round will take 20 to 30% of the company. So if that is the math, the first round of funding that you do, either through angel or VC funding, is the most expensive round of funding. What do I mean by that? So in the first round of funding, which may be $100,000 or $200,000 round, you may raise $100,000 or $200,000 and get diluted by 20%. And you could do a later round, which is a $10 million round when you're far more evolved. And you will still get diluted by 20%, but you'll raise $10 million. Most entrepreneurs then say, okay, fine, then why don't I raise more money now if I'm anyway going to get diluted? I think as an entrepreneur, it is important to recognize where you are. So if you're just starting out, no one's going to give you $10 million in the first place because you haven't proven your product or service. You haven't established that the early adopters. You may or may not have a team. You haven't gone on your journey. So it's important to recognize where you are in your evolution before you figure out how much for how much. But the industry thumb rule is 20 to 30% per funding round. And the more funding rounds you take, the more diluted you will get.
Risha wants to ask, for an initial presentation to the investor, do we need to have a lot of detailing?
The answer is you got to establish how much detail you give is really up to you. But whenever you are in any investor presentation, you've got to demonstrate, considering you don't know the investor well and this is your first meeting, you got to demonstrate your understanding of the market space, the dynamics of the market opportunity, your plan to leverage the market opportunity, your differentiator of your product and service, the competition, how competition will react, your pricing strategy, your scaling strategy. So whether you give that level of detailing through a PowerPoint or you give that level of detailing through an informal verbal discussion would really depend on what you are more comfortable with. But if I were you, I will demonstrate my competence and I'd like to demonstrate my understanding of the market opportunity. The other important thing to recognize is that it is extremely important when giving a presentation that you take the investor on the journey, and two, before you start the presentation, in quick 2-3 minutes, give a great elevator pitch or give a pitch that gives a quick synopsis of the opportunity, your product or service, your pricing, your scaling plans, your team, so that the investor clearly understands that you are someone that they would like to spend more time with.
How can we detach our venture from VC's investment? If so, how and when? And what's the procedure?
Okay, so a couple of things. One, when you do your shareholding agreement and you do the term sheets initially on with the investor, some people put it in that the entrepreneur can buy back the investor at a fixed point in time at a certain valuation or with an IRR of a certain amount. I am assuming, considering this entrepreneur has asked this question, so this clause is either not in the SHA and or is not in the term sheet of buying back the investor with a certain thing. I think then it's a question of just being very direct with the investor and say, listen, and this may be because the investor has probably sat in G or a ENY or a Grant Thornton or a CA, your local CA, to do a quick fair market value of the enterprise. And sometimes you may realize that you may be buying out the investor for a percentage of the money the guy put in, or you may be buying him out for far more than what the guy put in. So either way, it's good to determine the fair market value of the enterprise if you don't have any contractual clauses put in.
Okay, we'll take the last question for the day.
Yeah.
It's by Mr. Sudhindra Chillapagari.
Okay.
We are a group of undergraduate students working on a couple of ideas. We are trying to build services using cloud telephony, SMS, APIs, etc. Now we are ready to invest our time and work hard to build the product. but investment cost is stopping us from proceeding further. So whether to go and raise fund, if so, whom to contact and will they fund? Another is bootstrap or take loans from bank or friends. Are there any funds or incubators which provide seed funding and encourage budding entrepreneurs like us?
So I think I'm going to merge both these questions together and say that typically you would see that in your own colleges or in your own cities you would have some innovation funds that are earmarked at your college incubator, university incubator, or an accelerator. So it's a good place that will be your first port of call. You've got to understand that wherever you have funding sources available, you are not the first in line. They get far more applications than they give out, and hence be prepared that when you formally apply for money, unless your product and idea can stand out, you may have an issue. In terms of the first plan, where you're talking about cloud computing and telephony and things like that, you may also look at applying for a grant from the Department of Science and Technology. They do fund budding ideas, starting out even when you may not have angel investors or VCs willing to cut a check. As a student entrepreneur, typically, and what I'm going to say may not be very politically correct, you will notice that raising capital is a little more difficult, because most investors do not view students as incredibly serious on return on investment. So as a student, it is important to keep it somewhere in the back of your mind that you have the added responsibility of convincing the investor that you are aware, because most investors are afraid that you are starting this venture in your second or third year and you will not follow through. So when come placement time in your final year, you may just drop the venture and go for placements or go for an MBA or do other things, and the investor may get a lot of egg in the face. So if you're a student and you guys are very serious on the plan, then you've got to convince the investor regardless that you are going to be around, you will execute on what you've set out to execute on. So it's something to keep in the back of your mind. But good starting places would be innovation funds. The government has set aside certain innovation funds. They don't give you much. They start at about 10 lakhs, but that's a good starting point. The other places, the Department of Science and Technology, both at the state level and the Government of India, go check out their websites. They typically have tons of stuff and a ton of schemes that may apply to you. There are unfortunately not too many accelerators and incubators in the country at the moment. That scenario is changing very rapidly and will change more rapidly as time passes. But do your homework.
Thank you very much, Puneet, for that interesting session.
All right. Thanks, Ankit, for your time. Thank you, everyone, for such a wonderful audience. All right. Take care. Bye-bye.
Thank you to all our attendees for participating in the webinar. We are glad that the questions kept coming in, but due to lack of time, we are unable to answer all. Please do send in your feedback and suggestions to us at eclub@nenglobal.org. Also, if you found the session interesting, feel free to blog or post about it. The recorded version of the webinar will be available on our website eclub.nenonline.org by tomorrow. Do join us for our next webinar on leveraging the internet for success of a small entrepreneur by Mr. Velan Lakshman, CEO of ITES Technology. This is a vernacular webinar and will be held in Tamil. Thank you once again and have a nice evening.